Well, back in April, developer Norman Radow offered to repay a $35 million loan that he defaulted on. It was all tied to a San Diego condominium project that he had taken over. And you know, San Diego got very hit in the real estate crisis. However, when he offered to repay this, the bank said, no thanks. So why? It's due to a new strategy by the FDIC. And here with more is the Bloomberg News reporter who wrote that story, Jonathan Keehner. And it's the bank, but it's also a group of investors, essentially.
That's right. We're talking about a portfolio of loans issued by a bank called Chorus, which I'm sure you guys know well.
Sure.
It was a $4.5 billion portfolio of loans, really some of the worst performing condominium markets throughout the country. The bank was seized last year, and the FDIC took over the portfolio, as they do quite frequently. In this case, they wound up retaining a big stake in that portfolio and actually brought in some big name private equity investors to manage the loan. And what we wrote our story about was some of the sort of perverse effects that we've seen given how this deal has been structured.
And perverse being that essentially the FDIC saying, no, we don't want you to repay this loan early. In fact, we want to keep it, right?
In essence, I'm not sure if the FDIC was doing the talking or if a manager managing the loans on their behalf. Okay. But according to Radow, yes, in our story, he says that he was not encouraged to necessarily pay back that loan. And the truth is, why would he? If you look at the dynamics of this, they're working off of a zero-interest loan, as we say in the story, granted by the FDIC. In effect, the FDIC is telling its managers, you don't need to sell this stuff right now. There's not, so to speak, a gun to your head that you have to go sell these assets in a bad environment. In fact, why don't you wait? And why don't we see if these markets recover, and maybe we'll all make a little more money.
I was going to say that they're essentially waiting and betting and hopeful that the markets will recover and they'll make more money off of it.
And that's the point. They're betting. They're actually providing more debt, in this case an additional $1 billion facility to build these condos. Just to be clear, we're talking about 100 real estate projects in Miami, in Los Angeles, in Las Vegas, some really all not terribly attractive real estate markets. So, yeah, in effect, the FDIC is one of the largest landlords at the moment of condominium projects in some of these cities.
Then just big picture this for us then, Jonathan. I mean, what is the impact of this experience from Norman Radow? What is the impact then overall?
It's interesting. The people who I think were most informed that we spoke to were able to compare this to the S&L crisis, to the RTC, and they say, look, this might look a little crazy on the surface of it, but the truth is, would you prefer that they sell in this market for pennies on the dollar? Is it not better to make a bet? And I guess that remains to be seen. It's up to the U.S. taxpayers and the banking system if they're comfortable with the FDIC making this bet. But certainly interesting, they're layering more debt on some already highly leveraged projects and not encouraging the borrowers to repay loans.
Well, perverse outcomes. That's an interesting way to put it. I think that you are seeing that. Jonathan, thanks so much for joining us again. Always enjoy your stories.